Good afternoon, folks. It's Dave Burrows. Thanks very much for tuning in today. We've been going through very interesting times, and I know that everybody's getting a little bit of cabin fever. We're all news junkies and watching every step of the news around this coronavirus. It has us watching what's going on in the economy. It has us watching a lot of experts giving their views as to what is happening, what will happen. And so I thought I would join the line and try and walk through what we see going on and what we're trying to get done in our portfolios. Before I get going, I just wanted to say you may have seen the announcement that over the last month, we put together an agreement to merge Barometer with a company called Roundtable Capital Partners, who will be joining us at our office on University once the final deal is approved in May. We don't expect anything to get in the way of that. I've known the principals of Roundtable, Jeff Speidel, Jim Allen, and Peter McCarthy for years. We have a very similar type of client base, although the things that they do I think are quite complementary to the types of things that we do. And we're all really looking forward to working together to putting together some great additional solutions for clients in investment portfolios. And frankly, I'm just really looking forward to working with them. They're wonderful people. So there will be more on that when we get closer to close. But we look forward to moving forward together. Just by way of review for those who don't know us well, at Barometer, our team has been very focused on trying to accomplish the three basic things that we've always focused on. First of all, trying to identify parts of our investable universe that show leadership characteristics that are outperforming other themes, sectors, asset classes, things that are being revalued positively over time. And actually, going through this most recent drawdown in the market, there is some very clear leadership that was in place coming into it and seems to be quite clear on the other side of it. And certainly some areas that we want to completely avoid. And there are actually big parts of the market that traditionally have been great places to invest, but we think right now are uninvestable. We're watching very closely to see as this recovery unfolds where the leadership will be going forward. What is it that is emerging? What is it that's pulling back? And as you know, there are times when we really have to play a lot of defense. And this has been one of those times because at the end of the day, we've all spent too much time building this little pool of capital that we have to want to go through a big drawdown and have to try and rebuild it. So we've been working very, very hard remotely, all of us. We've been doing 2 to 3 conference calls a day, often over Zoom as we're doing today. But it's been a time of a lot of work, and I'm sort of pleased with how things are going. Just again, as a reminder, this is a picture of equity asset class back to the 1800s. And along the way, there have been some great markets and some poor markets. This is the 1929 crash. This is the 1973-74 bear market. This is the 2007-8 bear market. And along the way, there's some great bull markets. This is the bull market of the 1980s. This is the bull market of the 50s and 60s. And it's really important, we think, to understand what the backdrop is. We believe we've been in a bull market for stocks since 2013 when we exceeded the highs from 1999. We've seen rising earnings multiples paid by investors along the way. There's certainly been pullbacks, some big ones, but in general, stocks have been working way higher. All of us have lived our investing lives during this. This is a different asset class, income, interest rates, long-term interest rates, and treasury bond yields have been falling steadily since 1981 in fits and starts. And so we've lived with a backdrop of falling interest rates. And a lot of people sort of have built their views as to what should work over time during falling interest rates. And we think that maybe there's some challenges there because certainly rates get low and then they work their way back the other way. And we think we are going through a generational low in interest rates. So the big question, has been for some time, where do we go from here? One of our core strategies that we started in 2000 as the market rolled over, I think is well suited to the kind of market that we're in. It's one we spent a lot of time on, and that's our income strategy. And it's been really great over time, sort of an 11% return back to inception in 2000. It's worked well through a bunch of rolling periods, but I want to highlight the fact that it's not because we knocked it out of the park in up markets necessarily. It's because we've generally been quite good at playing defense through difficult markets. When we entered the bear market in 2000, we had no idea that it was going to be a 2-year bear market, but we did see that certain parts of the market were behaving better than the rest, and they were income-oriented ideas. So we focused in those areas and actually did quite well. When we went into the financial crisis in the beginning in 2007, we had no idea what it would turn into. We did know, however, there were certain parts of the market not behaving well, which we exited, happened to be financials, and certain areas that did much better. And through using cash and targeting some of the stronger areas, did quite well going through that decline. And then, of course, more recently in 2015-16, the Asian slowdown and the blow up in the energy space, you had to exit energy and exit emerging markets. But the net of it is, strategy's done quite well through drawdowns, and this is something that we're really focused on, trying to manage drawdowns. Now, let's talk about current market. When we last did a conference call, it was March 23rd or 24th. We made a case for the fact that we believed that the factors that we needed to see to point to a near-term bottom were falling into place. The market fell 34% from tip to bottom. And then at that point, we got a very sharp reversal. Now, one of the things we talked about at that time was we got stopped out of lots of positions as things rolled over, and our cash position built, and it defended us pretty well. But toward the very end, really the bottom dropped out on the safest assets. And at that point, the bigger risk was selling and having the market whip and reverse. Now, it turns out that this has been the fastest waterfall or crash decline in history, faster, in fact, than the 1987 decline. And so when people ask us about what we think is going on, we've given some views, and the common thing that comes back is, well, this is a different situation than anything we've ever been through before. This is a healthcare issue. It may not have been started by an economic issue, and that's true. But I would say that people behave the same way in a panicked situation every time. They just may be driven by different things. But clearly, this was a very sharp sell-off. Now, going through the decline, I'm pleased with how our various pools held up. The equity pool gave up less than half of the S&P through to the worst day in the market. The income pool held in very well. The balance pool held in very well. So in general, the decline part we're comfortable with, but we still have to manage our way forward from there. If you took our income strategy back to 2010 and plot volatility in white and the S&P 500 in yellow, you can see that the big spikes in volatility in the S&P, we've been able to maintain relatively much lower vol through each of those spikes. The most recent one giving up less than, having 60% less volatility to the worst point. We're measuring 4-day volatility here. And then in fact, recently, since the bottom, again, much lower volatility. Market's been going through big swings. The daily volatility also has been quite low relative to market. Now, we needed to see a bunch of characteristics to see that we had made a near-term bottom. In the last webcast, we highlighted we'd seen extreme oversold conditions, apocalyptic sentiment, a contraction in stocks making new lows, falling correlations. In other words, stocks starting to behave differently from one another, not just all exactly the same, falling in price. We needed to see some strength on the first couple of rallies. We needed to see some risk leadership emerge. We needed to see credit markets get a little better, and we needed to see a flattening of the yield curve. We got all of those things. And since then, markets had a great bounce. So the question I keep getting now is it all clear? It's hard to imagine that it is. I think most people look at this situation stretching out in front of us and say a lot of unknowns. But let's weigh the positives and the negatives. You know, I think it was well put by one of our friends who used to be strategist at RBC, Jonathan Golub, and he talked about the stages of a decline. And he talked about the fact that we went through the panic. He talked about the second stage being a more optimistic stage where we got a lot of stimulus, sort of an offset from government and from the Fed and central banks around the world. Started to get some better news on the virus, maybe a slowdown or a flattening of the new cases. And that's driven a big bounce. So a lot less stress in the market, people get a little more optimistic. And then the question is, where do we go from here? In our last call, we said there's three potential outcomes. One is that we just get a V bottom, people look beyond the problem, but they look out to the next year and say, this is all gonna be over, and market goes straight back up again. And while I don't think that's impossible, we've said we think it's very unlikely. The second outcome would be that the market would bounce, they always do, sell off again, and then continue lower, and that we're in a new bear market. And I would say that that's a possibility. It's not the likeliest scenario, and I say that because we came into it from a strong economic situation. Market was on a good footing. Market breadth was solid. Very clear leadership. A lot of structurally positive themes in the market. And because we can look out and see there's a high likelihood there is some end in front of us at some point to this healthcare problem. And then the third possibility is that we go through a few weeks of noise. You know, we're going to get into now earnings, which are going to be negative, and get all the negative economic data and fallout from this most recent few weeks where we've all been sheltered in place, and that the market would chop around. And so we compared it to what happened in the crash in 1987, a very similar 32% decline over a similar period of time. You got a sharp rally. We went back and we retested the lows as people tried to figure out where things were going. We rallied again. It chopped sideways for just around 2 months to the end of the year. However, ultimately, the market started to look beyond it. We had a short-lived economic pullback, and then the market rallied 60% over the next 100 weeks. I'd say that's the most likely outcome. But what we said in our last webcast was we are not going to push a bunch of money into the market when it starts to rally. We've held some wonderful positions on the way down that held up much better than the market. We're going to hold a cash position. We're going to stay pretty defensive, and we're going to let the market show us where the new leadership is. Because after the market bounces, when it pulls back, the things that were just short covering rallies will fail. And the real leadership will emerge. The stuff that bounces off the bottom and holds up once the first sell-off comes. Okay. So if we took the different scenario, 1929, even then, very sharp rally, pullback, chop sideways, again, 6 months. And then ultimately the economic slowdown overwhelmed the market, and then it was a different story. So in both cases, you'd want to have some cash. In both cases, you'd want to stay pretty defensive. You want to see the market prove itself. It's not a race. We don't have to push it all in at once. Okay, so here's where we sit today. We said the market would rally between 38 and 50%. Well, we've rallied 50%. In fact, you know, there's a handful of rallies like this that have happened over time. They've all happened after waterfall declines. Most of them, like 9 out of 10, have gone back and some way retested the lows. So, you know, after a very good couple of days, we had a down day today, and it's very possible that we've begun some kind of a retest. Over the last few days, we actually reduced some exposure in the portfolios. They're all different. Macro portfolio is all hedged. Income portfolio has some cash and has a lot of defensive sectors, and the balanced portfolio has lots of fixed income. All three cases, we have tons of flexibility. If it gets better from here, what's interesting is in the last couple of days, you've had technology and healthcare rock solid, and financials and industrials, things that would likely get hurt if this went on longer, have really been quite poor. Market was up yesterday, financials were down. A lot of them reported earnings down 5 and 6%. Industrials similar. Here's the data. If we take crash type scenarios back to 1929, a lot of significant declines and a lot of significant declines and a lot of significant bounces that came after the decline. But if you work your way forward 1, 2, 3, 4, 5 days, you can see a lot of negatives. And in fact, if you took all those occasions before the market kept going, you got some sizable declines over not that many days. So this is why we haven't been too aggressive pushing money into the market. If we take other major market declines that weren't crashes, big declines, big rallies off the bottom, and then retests. So this is what we think is most likely, but we keep an open mind. It's possible this is a V bottom. It doesn't act like it. So here's how we are now to date. If we take the equity portfolio, at the worst point, we were down 17%. The S&P was down 34%, TSX was down 31%. As we sit today, the equity portfolio is down 6%. The S&P is down 12% and the TSX is down 16%. We're defensive, flexible. We can manage whatever comes at us. The stronger parts of the portfolio and the focuses in the equity portfolio are in the equity leadership, and equity leadership has continued to be technology. This is relative price behavior versus the market. It's risen the whole way through. Great bounce off the long-term moving average. And there's a bunch of themes in here that include cloud, cybersecurity, subscription-based software, semiconductors, all of these groups behaving quite well. And healthcare, of course. And this includes biotech, medical devices, and managed healthcare. So these are key areas in our equity portfolio. If you take the balanced portfolio always has a little fixed income in it. Right now it has a fair bit. Was down only about 14% at the worst point, well less than half of what the market was down. Today sitting down 5.9%, well ahead of S&P and TSX. Again, flexible but different. Fixed income, but we have some exposure to some defensive sectors. But again, the strong positions in defensive sectors. So NextEra Energy is an example. It's a utility, but it's a high growth utility, and it has the highest percentage of wind power and solar power of any utility in the world. Again, relatively performing well. It's got a nice yield. It's had a great bounce off the bottom. We'll see, held the long-term trend. We don't have a lot of REIT exposure, but the REIT exposure we have is quite unique. American Tower is one example. They own cell towers. And we all know we're using a ton of mobile data and we're rolling out 5G around the world, and American Tower owns the REIT that owns the towers, which is like a hotel with an unlimited number of rooms. You can keep putting gear up on the towers. So we're really watching not only to manage the decline, but what is it that's coming back quickly? What is it that's stronger than the rest of the market? In the income portfolio, this portfolio can be in bonds, it could be in dividend paying stocks, it could be preferred shares, it could be in convertible bonds. We know this is going to be a great opportunity for this fund. When we went through the financial crisis, coming out the other side, the opportunity to buy credit and bonds, corporate bonds, was fabulous. Preferred shares, fabulous. Right now, we have some cash and we've got some defensive sectors. But again, down about half of what the market was down at the worst point. It's had very low volatility since then. We're still well ahead of all of our benchmarks. We've had much lower vol along the way. And here, another couple of examples. Fortis, which is a high growth dividend payer, and Microsoft. grows its dividend over 20% a year, dominant in the cloud, dominant in subscription-based enterprise software, performing really well, and is a great hybrid dividend growth-oriented security, which is where we're going in the income portfolio. So they're all different, but ultimately there's some real strength. What you don't see is you don't see a lot of industrial weight. You don't see a lot of financials weight like traditional banks. We do have some exposure to index providers like S&P Global, which of course sells their index data. But the net of it is, we think that despite the fact we've been through this crushing decline, we're facing one of the great generational opportunities, like the 1987 crash. So far, we remain in a secular bull market. We've been tested, but at this point, we're still in a secular bull market. If you take a look at the leadership in the market, the NASDAQ's been in a very clear upward bias trend since 2008 and is showing no sign of breaking down. Even today, when the market was down 3%, Amazon and Microsoft up on the day, Apple up on the day. Now that can change, but at this point, that appears to be where the leadership is. Now we think going forward, we have to think a little bit differently. And we've talked about this for a while. We think that we're all used to falling interest rates. We're going through what we think is a generational low in rates. It's hard to imagine there will be much more than what we've seen to push rates to their lowest levels, including incredible intervention by central banks. But when we go back and look at what happened in the early 1950s, it was very different than where people have been going now. Now we've seen falling rates, and so as a result, you've seen lots of money piled into bonds at the lowest yields in a generation. And we know money's been coming out of stocks for quite some time, several years. But when rates bottomed the last time in the early 50s and then went up for 30 years, money slowly worked its way back into equities. From 1951 to 66, stocks went up 15% a year with interruptions. Bonds went up 1.6, inflation was 1.6, so that was a 0% rate of return. And dividend growth became the theme. So as much as we all hated the financial crisis in 2008 and 9, it created opportunities. This will create opportunities. There's a terrible human toll going on from a healthcare perspective, and we hope that the scientists will come up with solutions for this problem. But financially, our job is to manage our way through this. And I think that we're going to go step by step. So we don't know whether we will retest the lows or not. We know that we can maintain flexibility and a defensive stance. We know that should we be able to get beyond certain levels in the market and get more information, we can start adding additional positions. We think there's going to be opportunities in credit markets. We think there's going to be opportunities in equities. And we're going to take our time, step by step. So where we have cash, we will piece it in bits and pieces as we go along. We know our strategy's done really well in rising interest rates over time. Every rising rate period for 10-year yields since 2000 was a negative time for bond investors, but a positive time for our investors in this tactical income fund. This is one of the places we would be looking to add new money. I know this is a difficult time. We look forward to working with you as we go forward. If you have any questions, please don't hesitate to give us a call. We do have some questions we'd love for you to answer if you have an opportunity. And thanks very much for tuning in.